Welcome. I'm attorney James Davis, and this is Politically Incorrupt. Today we're talking about the financial markets, real estate, bankruptcy, and all your type of financial planning. If you've got money to plan with, stay with us. If you need to buy real estate, buy or sell, think about selling your home, thinking about buying a new home, stay with us. If you think about bankruptcy, if the economic crisis is having you in a bind, stay with us. We're going to get you where you need to be, what you need to know about what's going on in today's market. We're going to have with us today Rob Pellissier from Edward Jones Investments and Linda Solomon from Griffith Real Estate. Linda, can you tell us a little bit about what you do?
Sure. I am a real estate consultant with Griffith Real Estate here in Macon, and I focus primarily on residential sales or purchases, as well as homeowners that might be facing distress, such as short sales. Like to share with them their options.
And Linda, I've been knowing Linda for a long time, and she's definitely the real estate agent that will work for you in all different kinds. I do a lot of creative real estate, and Linda's right there with me trying to encourage me to do that.
Sure.
Rob, I've known Rob for a while as well. I've known him through Noonday Optimist Club. He was the president for a while. And what's your position now?
I'm the lieutenant governor for the Middle Georgia area for Macon Noonday Optimist Club.
Okay. And also with Eddie Jones Investments. And tell us what you do.
Correct. I'm a financial advisor with Edward Jones Investments. Have clients all sizes. I have some that are just starting out, and I have some that have millions of dollars with me. And so we can create complete financial plans, or if you just have a specific need, then we can look at that one need and curtail it to custom for you.
Okay. Cool.
Okay. All right. And also Think Inc. is a part of what brings this program to everybody. And Think Inc. is a program that we're designing. It's similar to the Optimist Club. We're trying to get where it's bigger and bigger, where we have groups that get together and look at political ideas in the environment and have people, rather than accept what one side says or another side says, to kind of group together ideas and philosophies and try to make them work regardless of religious affiliations or political stances on the issues as a whole. Cool. It's called Think Inc. It stands for Theological and Historical Insights Inspire New Knowledge. What we look is the religious basis of some of the laws that we have in government now, and how those have interpreted the laws as they sit. And we try to get people and encourage people to actually think, rather than just pick a side and then try to support their side, but think through the things. That's why we've done a previous show on immigration. That's why we're looking at the issues that are going on today.
Cool.
So in the current environment, Rob, tell us a little bit about what's going on in the economy.
Well, currently what's going on in the economy is the most pressing thing that is pressing us as the economy right now is the national debt crisis. And right now we're pressing the $15 trillion mark, and of course President Obama and all his affiliates are trying to raise the debt limit because we're basically running out of money as a national economy. To raise the limit takes a lot of, as you know, a lot of legal boundaries and laws to pass to just get it raised. But what it's basically doing is that there's concern that if we don't get this passed in time, that America could potentially run out of money. No different than our own individual budgets. Running out of money and not able to pay the money for our debts, our payments, our credit cards, our homes.
Okay. And is that creating new investments? How is that affecting your job and what you do with people, how you use people's money?
The stock market is very emotional, so whenever there is uncertainty in the stock market, like the debt crisis, people tend to get a little shaky. The stock market tends to be a leading indicator, so what I mean by that is if any bad news comes out, the stock market reacts very quickly, and people tend to want to pull money out of the market very fast.
Okay. All right, Linda, what's going on with mortgages and home
Well,
sales these
I was
days?
going to say, and I'm sure if we don't raise that debt limit, it's going to affect our buyers being able to get mortgages as well. Right now, there are a lot of products out there. Of course, you have the regular VA mortgage, then you have conventional, and you have FHA mortgage, which of course is insured by the federal government, which we also depend on that to help. Home sales are holding steady. They're a little wavy, I would say, because of the foreclosure crisis. But buyers are coming out because it's a great time to purchase for first-time home buyers and investors.
And most of those first-time home buyers, are those government-sponsored programs?
Most of them are.
Okay. And what's the criteria generally for some of the first-time home buyers type of thing?
Basically, especially if they're doing the FHA loan, it's like 3.5% down payment, and then of course there's the FHA funding fee and insurance fees that go along with that. But it allows the purchaser to be able to at least meet that down payment guideline, which is great.
Okay. And what's the change-up that the government's got going on now, or that that they're offering now in these programs for interest and that type of thing? Are they still? I know the interest rates are still low at the moment.
They are. Interest rates are still below 5%, which is great, which is certainly a big difference from a few years ago, like the 80s, where we were talking about in the high teens.
Right.
So it's still a great time to purchase. There's something there for everyone. Just
and Rob,
about.
can you kind of tell what's going on in the environment? What's keeping these real estate interest rates low? Are they artificially low, or is this,
you might have heard of QE2, QE1, quantitative easing that was passed by the federal government or the Fed, Fed funds rate. Ben Bernanke, he is in charge of the federal funds. And he is trying to keep these rates as low as possible to spur the economy, so people can borrow money to buy houses, cars. Small business owners can borrow money to help expand their business. So the economy got very sluggish, as you know, in '08 because of all the debt crisis. What was the term that they were using? The mortgage. Oh gosh, I can't believe I can't remember that. But it's the
the credits, the first
credit crisis, mortgage crisis, where things they were basically what was happening was large investment companies were taking poor quality mortgages, and then they were taking these poor quality mortgages, subprime mortgages, thank you, bundling them up, selling them as AAA rated quality, credit quality rated investments, and passing them on to investments. And then these started defaulting like crazy in 2008. So when the economy went into turmoil, one of the things that they try not to do, like what happened in the Carter administration, was that interest rates started to rise very quickly back to what you said, the 10, 15, 18% CD rates and mortgages. And so they try not to go back to that 70s crisis. And so what Ben Bernanke has done is try to keep the interest rates as low as possible to try to keep us from going into hyperinflation, is what they call that.
Okay, and explain to us what hyperinflation is.
Hyperinflation is when things, the rate that you borrow money is faster than what the things that you can go purchase the product for. So in other words, if you could buy a $10,000 car, but it may cost you 15% money to buy that car, and at the rate that you could afford to make the payment, that over a 7-year period, you still may owe $10,000 on the car.
Okay, so the interest is accruing faster than what you can pay down.
That's exactly right.
For what you're doing.
That's exactly
and that's called hyperinflation?
Yes, it is.
And is that driven by what the interest rates are? Is that created
Yes.
by the interest rates themselves?
Yes, everything is based on the federal funds rate, and the federal funds rate is the rate that the banks can borrow money. So right now, that rate is actually at about a 0.5 or 0.25 interest rate. So it's very, very low. I mean, it's almost free money to the banks if the people have credit quality to borrow it.
Okay. And what do you think is going to happen? In my personal opinion, I think we've got a bad inflation problem, hyperinflation or something coming along very soon.
Correct.
Because of some major factors. One is interest rates are very, very low. And this is true for mortgages. I can remember back in law school, 2000-ish, hearing people, knowing people that were getting zero principal mortgages, where we moved from a time where we had very low interest rates, where they were going down. I remember 20 years ago, I was in real estate. I did air traffic control before law school, so I've spent years doing a few other things besides being an attorney. I love what I do now, but the other things have given me a lot of experience in different areas. One of them is real estate. I remember 20 years ago, at least 20 years ago, when I was doing that, thinking prices have to come down. They were already too high. And then everybody thinks I was wrong in that, because during those 20 years, the real estate just boomed. But if you look at it, a $100,000 home was costing less and less and less during that process because of the adjustments during that of interest rate. So even though the price of the sale of the home was changing, the price of ownership of the home was actually coming down. And in my estimation, that was sort of an artificial way.
Right.
You know, rates might have been 12% at one time early on in that, and then they started going down a little bit. So a $100,000 home was costing $1,200 a month to buy. Then it became $1,100 a month for the same $100,000 home. Then it became $1,000, and it went down to where a note on a $100,000 mortgage might be $600 and something dollars.
Right, right.
So it actually was coming down, although the price was booming. But nobody, or very few people, actually owned those homes. The banks were owning them, and you were paying something to get them. Prices were still soaring. Is that kind of an accurate description of what was going on with that? And once you get, I remember saying they can't get any lower on interest. Before you know it, they're going to have to pay you to get it. And I really was joking, but that did happen.
That's exactly
That's
right.
exactly what
That's
happened.
exactly what happened, right. And that's called disinflation. So, you know, that's basically the reverse effect of hyperinflation, to where, you know, there was free money out there, it was flowing out of everybody's pores. Come get it if you're a walking, breathing individual. Here's money, we're going to give it to you.
Right. And so how is the inflation, the whatever they're doing with these markets, with the loss or the deflation of real estate prices, for example, combined with the printing of money, which seems to be what's going on now? How are they going to curb that printing of money to keep that from creating a very large inflation rate? I know now they're sort of holding interest rate down, which helps that.
Right.
But what are they going to do? What's the plan long term, or what can they do long term when you have a saturated market with money? You know, if we have, if we spread out 21 toothpicks in there, we got 7, and then we want to bid on a pen. You know, it depends on how many toothpicks are out there, how much it's going to cost.
Well, what you're saying is exactly what Ben Bernanke has been trying to do with QE2, with quantitative easing 2, is where they're buying back American bonds. So basically, it's no different than you being the owner of a company and you've issued out all this company stock and it's worth pennies on the dollar. But you know for a fact you own a building, all these vehicles, you have great employees, you have computers in all of the rooms. You know for a fact if you liquidated that, you could probably liquidate it for $10 per share versus the pennies on the dollar that it's trading. So what the federal funds has tried to do is buy back the American bond to prop it back up, because they know that ultimately our dollar is worth more than what it's trading for.
Okay, so the dollar's worth more, even though there's how many more dollars are out there now than there were, say, 3 years ago?
That I don't know that answer.
It's significant. Am I right on that?
I think there has been.
From what I'm seeing, it seems like that.
It is certainly diluted. It is certainly diluted because we've borrowed so much money from countries like China. China is our largest bondholder, and there is talk that if China came to the United States and said, "Hey, we want our $20 trillion back," we would have trouble coughing it back up.
Right. But not just discussing the debt, which is obviously another crisis that we've got going on right now, but just the extra printing. How much does that diluting, having more money out there, having more money in the system, is that really having an effect, or are they going to just withdraw that money back in over a period of time?
You know, we could, I mean, you're right, Jay, we could have a point, and I'm not trying to scare everyone, but there is a potential problem, just like in the Philippines, for instance. You know, it may take 1,000, whatever their currency is, to buy a loaf of bread. I mean, here we could be walking around with $1,000 bill in our pocket to buy milk. So that is the long-term effect of weakening the dollar. Instead of paying, you know, $1.50, $2 for a loaf of bread, you know, ultimately we could be paying 20.
Well, for those, there's a lot of things going on with the markets, with the economy. A lot of people are feeling a crunch. Some of the people are able to have homes. Linda's able to kind of help those people who haven't overridden it. One of the things that we do, obviously we do real estate, work with Linda a lot. If anybody's buying or selling a home, come talk to us. Rob, you've come with us. We've worked with you. We appreciate that.
Thank you.
It is a choice, buyer or seller. It is a choice on the attorney that you use. Make sure you ask your mortgage lender. Make sure you ask your real estate agents to come over and join us at the office, James W. Davis and Associates. But one of the things we do also is bankruptcy. And a lot of this economy has caused a lot of problems with people that have individual bankruptcy.
That's true.
And bankruptcy gives a lot of a broad people. It used to be a certain group of people. You had the really high-end people who would make some huge investments, and then they wouldn't go well. They would use that, like Donald Trump, in order to get out of it and to start over. It kind of was at the high end and the low end, and people at the lower a lower economic scale had more likely to get themselves in financial trouble, and people in the middle sort of stayed not so much in it. But now it's across the board. It's across the board. And a lot of people are wanting to, they're feeling like they need to pay it back. A lot of people are hurting and not sure how to get out of it. So I want to talk a minute about how they might be able to get out of those types of crises. But there are two types of bankruptcies that apply to individuals when they're not with a business. That just the individual themselves, or the Chapter 7 and the Chapter 13. In either case, these days you have to do a credit counseling course. It costs $36 generally to do it online. And in either case, you're entitled to exemptions. If you own a $100,000 home that's paid for, you're probably not going to be able to do a bankruptcy and wipe out all of your credit card debt while you're sitting on a $100,000 home. But the law does allow you to have $10,000 in a home. If you're married, it allows $10,000 for you and $10,000 for your spouse, or $10,000 for anybody else who's a joint owner on that home.
That's a lot of money.
So if you've got equity, these days people don't have much more than $10,000 worth of equity in a home. And if you had a home that you had $100,000 worth of equity last year, you might not have any equity this year. So it is a pretty open time to be able to do a bankruptcy for most people. Chapter 7, you just wipe out all your debt and you start over again. Chapter 13 is designed to restructure some debt. If you've got a car, you got an 18 to 25% interest rate, you can bring that down to 5.25% usually, and then pay that out. If the car is worth, if you still owe $20,000 on a car you've had for 3 years and it's only worth $7,000, you might can bring it down and pay the $7,000 in order for you to keep your car. So there's some options for people to do that. But that brings us to the moral dilemma. Sometimes people are going through a moral dilemma. They're saying, I really want to pay my debt. We have some people who just say, look, I'm out of it. But we've also got the moral dilemma on what they do and whether or not it's appropriate to do a bankruptcy. People, for different religious beliefs and that type of thing. So obviously there's the moral dilemma in bankruptcy. One of the things is, this is virtually some of what, how does a bankruptcy compare to how some of the bailouts that have gone on with companies through the government? Are you familiar? Do you keep up with those
Can you rephrase that? How does the bailout?
The stimulus plan, what people refer to a lot as the bailouts of different big companies. Most of these big companies that I have people coming in and crying in my office not wanting to not be able to pay their debts regularly. But there's also the people they owe are Capital One, Chase,
Bank of America.
There are a lot of different companies, and some of these companies are also involved with a similar plan where they've gotten sort of a free ride. What has the stimulus plan seemed to have done from what you can see with the companies?
The design of the stimulus plan was originally designed to come out and free up this tight money, because money had gotten so scarce in 08 and 09. They passed the TARP money, Troubled Asset Relief Program, to where they loaned money out to people like Citigroup, Lincoln Financial, just all these great large organizations, to where they would have a cash flow, a cash reserve, that they would not just hold on to their money, because that's what these large companies were doing. They were scared. People are going to quit paying their payments. Let's hold on to our cash reserve and not give it out. So the TARP money came out to help give them a cash flow entity to allow them to loosen it up. And a lot of it, there was large complaint that a lot of that did not happen. They kept that money close by. Sorry.
And Linda, in around 2000, a little bit before 2000, I was leaving air traffic control and getting prepared to go into law school. I had some houses that I had bought at low prices that I'd fixed up. I bought one for $5,000 over in South Macon, and got one over in Bloomfield, and I'd purchased those. And the actual way I could actually sell those properties were the government was just giving away loans. They were giving people who had never paid their rent on time. They ultimately, I know at least one of the houses became foreclosed, but it was a government structured loan where somebody bought the house. They were able to pay the asking price for the house, or they negotiated a price for the house and pay, which was a good deal for me. What can the government do? What can the new programs do with the mortgages to keep from getting in a situation where people are defaulting? I believe that people just gave away mortgages to people who they knew weren't able to do them.
I agree, and what I was going to say, some of the things that they're doing now, though, is they're approaching it more in terms of education, because before there wasn't that educating the public in terms of purchasing. So now you have to go through the home buyers seminar, have to know how to plan your budget, have to know how to live within your means as opposed to just getting free monies. I think they realized that they dropped the ball in not preparing buyers to be homeowners. So we are sort of curing the problem instead of preventing it from way back then, you know, and I think that's a good thing.
Yeah, I can remember the talk of you know, everybody, every American owning their own home, which to me is kind of ridiculous. I don't think that every American wants to own their own home, but I do think that it should be a realistic possibility for Americans. But I think the problem was they were sort of giving it away for nothing. Is that what your analysis of it is?
I would think so, because there weren't the strict underwriting guidelines. They had gotten a little slack. Of course, again, they're trying to correct that again. And now with Dodd-Frank, they're trying to bring in this qualified residential mortgage where folks will have to put at least 10 to 20% down. It's going to take them at least 10 years to save for that. So, you know, that's an almost impossibility unless they choose the FHA product, which requires only the 3.5% down. And part of the reason with that is now they want the lenders to share more in the risk of the defaults. And to address that, they're bringing in these strict guidelines in there, which is a whole nother story and a whole nother show.
Okay.
Just to tag on to that, Jay, I think a lot of what happened was a lot of people bought larger homes than what they could afford ultimately, 300, 400, 500 or above homes. And a lot of what happened also is that they did interest-only loans. So in other words, you get this $500,000 home, you can't truly afford a 30-year mortgage, but what happens is you control that home and you pay the interest only. So instead of paying the true $2,000 a month mortgage, you're paying maybe $1,100, $1,200 a month. The premise behind that was originally interest-only loans were designed for large presidents of companies like WMGT that make a lot of money. Maybe they don't make a large salary, but their bonuses are very large. So they wanted them to have a nice home. Once a year they get a large bonus. They take that bonus and they plop it down towards the principal of the home.
And it goes down.
But what happened with the interest-only loans is that people, ordinary people, controlling these large homes, 5 years later it becomes a balloon note, and now all $500,000 is due, or you refinance. So what has also happened is that when they went to go refinance, they still owed $500,000. Now it appraised for $350,000.
That's exactly what I was going to say, because then the price fell.
I know during that period of time, everybody that I knew of who was getting one a no interest, a no principal, an interest-only loan, everybody thought real estate prices go up. They always go up. That's what's going to happen. And I've had people in my office and had with a discussion like that with certain people saying, yeah, well, real estate always goes up. I mean, you know, 2008 and before, people would say that. And I would have to say, well, it doesn't, you know, always. You know, it has historically gone up. But since then, we know that that's not the case. But it seems like maybe the government should have known that a little bit sooner. Weren't the indicators out there? I can remember in 2008 when they were discussing the interest rates going up, and I thought, they can't let them go up. They're going to have to go down.
But you know, Jay, even though you're saying the government should have known that, I agree with that to a degree, but I think we all share the responsibility. For example, educating our buyers that something is not going to go up forever.
Right.
And there's going to be a day of reckoning. So what kind of plans are you putting in place? It's just like insurance. If you're driving a vehicle, you don't plan to get in an accident, but something is going to happen. So you have to make plans, which is where this guy comes in.
But there's some degree. I totally agree with you, Linda. I'm definitely one that people should. That's what the whole purpose of Think Inc. is that we want people to begin to think and not rely. But the products that were offered for quite a number of years created a situation, in my opinion, created the situation for what has happened. The lowering of the interest rates created a higher inflation of the real estate market. And then the type of loans that were offered to anybody who said they wanted a loan, they were virtually approved and able to get a loan for any amount of money. There was no real check on it. I think people as a whole are going to have to start looking out for themselves, like you're saying. And we have to start looking and say, not depending on whoever the political leaders are, whoever the mortgage lenders are, and those types of things. We kind of be educated. And that's part of what you do in your process with your clients, isn't it? To kind of educate them on on what they may need, what the markets are, let them kind of think through it.
That's exactly right. It is a long process. We do review mortgages. I'm not a mortgage broker, but we do review it to see, what other options are out there for them to try to help them with a good plan.
Okay. Well, we're going to have to wind up now a little bit. Tell us a little bit, Rob, as we start heading out, a little bit again about where you are and what you do real quickly.
Great. I'm a financial advisor with Edward Jones, and I'm right on Vineville Avenue. I'm next door to the Georgia Academy for the Blind, and we do financial plans, anything from very small to the very large. So I'd love to help you if you need any help. And if you have any questions, please feel free to call me or consult your own financial advisor.
All right. Cool. And Linda, with Griffith, what all do you guys do? I see you guys regularly, but tell us a little bit what you do.
Well, we do a little of everything. Personally, I focus on residential purchases or sales for buyers and sellers, of course. And I am also assisting a lot of distressed homeowners, meaning people who have fallen behind on their mortgage, not sure what to do, help them to understand the options that are available, and especially short sales. The Mortgage Forgiveness Act is going to sunset, meaning expire, next year, December 31. So anyone that's feeling that they're upside down and need to take action, you need to think about doing it now. Don't wait, because it takes time to process those short sales, but it's a way out. It helps you in terms of not totally destroying your credit, gives you the opportunity to repurchase later on, and bottom line, it's something you might want to consider.
Okay. And I'm James Davis. James W. Davis and Associates is my law firm. We do divorce. We do criminal law. We do big part of our business has been real estate. It's a little bit low. Everybody's a little bit slow at the moment in the real estate, and bankruptcy. That's one of the primary things that we do. So we can give you some relief in the bankruptcy area. If there's anybody out there who's really thinking about bankruptcy, give our office a call. We'll put that on the screen, but the number is 742-1440. We'll try to get those numbers on the screen for all of us on there for you. But there's lien strips. Sometimes people have a second mortgage on a loan. The first mortgage, it used to be an 80-20. People used to give 80-20 loans a lot. If you've got one loan that was 80 and 80% of the mortgage was $80,000 and you had a $100,000 home, you had another mortgage for 20. If your house has fallen below the 80, so now you still owe $80,000 on one mortgage and it's worth $75,000, and you still have a $20,000 second, bankruptcy allows you to strip that second mortgage. If you're struggling to make either of the mortgages, the bankruptcy allows you to strip that second one off if it is not secured at all under certain types of plans in a Chapter 13. And a Chapter 7 can get it. And again, we do real estate. If you're buying or selling a home, it's a perfect time to buy.
It is.
It's low prices right now compared to any other time. And if inflation does kick in like we think it might, houses will go back up, and if not immediately, eventually. Also, there's Think Inc. If you want to support Think Inc., you can do that in care of our office at 143 Lamar Street. We'll put that up there as well. We'll also put the post office box for them.
Cool.
So aside from that, how is Optimist Club going there, Rob?
Well, it's we missed our meeting because of July 4th, but we're going to pick up next week, and I think we have a great speaker. I think Jamie Gaudet. Is coming to speak about the Macon Police Department. So I think with everything that's gone on with the law student, I think that'll be an interesting topic.
Right. Cool. Between that and the Casey Anthony thing, I think we'll have plenty to talk about.
That's right.
I'm Jay Davis. Thank you for watching Politically Incorrupt.